Welcome to our CFP Exam Prep podcast. Today we're diving deep into gross income inclusions, a crucial concept that frequently appears on the CFP exam. Understanding what constitutes gross income is fundamental to tax planning and often challenges candidates. Let's break down the main components of gross income. The tax code defines gross income as all income from whatever source derived. This means compensation, business income, interest, dividends, and certain fringe benefits must be included in a taxpayer's gross income. Starting with compensation, this includes not just your regular salary and wages, but also bonuses, commissions, tips, and severance pay. A common mistake candidates make is forgetting that constructive receipt applies here. If you have the right to receive income, even if you choose not to take it, it's still taxable in the year it becomes available. Business income is another significant component. This encompasses profits from self-employment, partnerships, and S corporations. Remember that business income is reported on different forms depending on the entity type. Schedule C for sole proprietors, K1 for partnerships, and S corporations. Test takers often struggle with timing issues. Business income is generally taxable when earned, not when the money is withdrawn from the business. Interest income includes both taxable and tax-exempt interest. Here's where many candidates trip up. While municipal bond interest is generally tax-exempt at the federal level, it might still be taxable at the state level. Additionally, some municipal bonds can trigger alternative minimum tax. Pay special attention to original issue discount bonds, as the accrued interest must be reported annually, even if no cash is received. Regarding dividends, the exam often tests the distinction between qualified and non-qualified dividends. Qualified dividends, taxed at preferential capital gains rates, must meet specific holding period requirements. A common error is assuming all dividends from domestic corporations automatically qualify for the lower tax rate. Fringe benefits represent a particularly tricky area. While some benefits like health insurance and life insurance up to $50,000 are tax-free, others must be included in gross income. For example, moving expense reimbursements are now taxable for most employees. The exam frequently tests scenarios involving company cars, gym memberships, and education assistance programs. Let's look at a practical example. A client receives their regular salary of $100,000, a $5,000 bonus they defer to next year, $3,000 in municipal bond interest, $2,000 in qualified dividends, and a $1,500 gift card from their employer. Many candidates might incorrectly exclude the deferred bonus or gift card or misclassify the municipal bond interest. The correct approach is to include the salary, bonus due to constructive receipt, gift card as a taxable fringe benefit, and qualified dividends while excluding the municipal bond interest. Remember these key points for the exam. Constructive receipt applies even if you don't physically receive the money. Not all tax-free benefits remain tax-free if certain limits are exceeded. Income is generally taxable when earned or received, whichever comes first. And always consider the specific requirements for preferential tax treatment, especially with dividends and certain fringe benefits. By mastering these concepts and understanding their nuances, you'll be well prepared for the gross income questions on your CFP exam. Focus on identifying what must be included versus excluded and pay special attention to timing and classification issues.